Good evening, everyone. My name is Paul Young. I'm just going to do a quick video on the November 2000 economic indicators for Canada. Some of the information will be North America as well, but basically I'm just going to walk you through some of the key drivers. So my agenda will be GDP, Canadian manufacturing sales, housing starts, retail sales, exports, commodity prices, and currency. Now, this has been a real tough year for Canada, and most of you have seen that. Basically, due to the economy driven by a lot of major factors like oil and commodities, whether that's nickel, iron ore, copper, all are driving basically GDP growth. The oil itself has had a major impact on GDP growth this year, especially in areas like Alberta, Saskatchewan, and Newfoundland. Okay. Also on top of that, manufacturing's had some struggles as well, and that's driven GDP down, but there's been some positive signs of manufacturing in areas like forestry, which is driving the housing starts in the US. Car manufacturing has hit an all-time high probably since 2007, pre-recession. Food processing is very good as well. But they haven't been, the issue has been, they haven't been strong enough to offset the losses that have happened in the oil and natural gas, oil in the mining sector. Look at Canadian manufacturing. This highlights like what you show here. In the far right hand column you see about, on average compared to last year, oil, petroleum products, that's your oil, is about almost $2 billion off of where it was last year. So what you're seeing is other sectors like transportation and food processing and forestry have offset some of those losses, but they haven't been sufficient to offset the complete buffer. Now a lot of that you're going to say is driven by policy. Yes, it is. You're looking in the manufacturing policies, especially in Ontario, that the Kathleen Wynne government has basically brought in disaster after disaster policies that's driven manufacturing base out through high hydro rates. That's one of the issues. The other thing that you're dealing with as well is Canada exports a lot of stuff to the US, and the US economy still hasn't grown by leaps and bounds. So in terms of our exports to them, they're growing, but they aren't growing at a significant pace. So I wanted to highlight that as part of the overall rationale behind it. Housing starts has been one of the strong points this year for Canada, and that's one of the reasons why you're seeing in terms of the employment numbers, we've actually had gained net jobs this year. Is part of that's because we've had a strong retail in the housing sector. So even though part of the GDP, the good producing sector, has struggled, we've had some good signs around areas like construction. We've had good signs around the retail side. So that all kind of shows you that even though Canada has some struggles this year with the economy, it's still doing decent compared to some of its peers. Retail sales. Now retail sales is a big driver of GDP growth. Okay, that shows you how many people are spending money. If this was a negative growth, it actually would hurt the economy. And that means basically people are spending money. Spending money in the economy gets the tax dollars circulating and gives the government revenue both from the profits of the retail giants as well as the HST, the sales tax. That funds various programs like healthcare, education, as well as different programs from a federal to a provincial to a municipal level in terms of driving taxation. Exports. Let me highlight here. So what you're seeing here on the export perspective, I compared this basically the average for 2015 to the last 4-month run rate for 2014. And what you're seeing here is of the exports, $2.1 billion of exports was lost due to oil. Part of that's price, part of it's volume. Because we've seen huge drop in oil prices from about $75, $80 a barrel down to $35, $40 a barrel. And it's not hit its low level yet. There's talk that may drop down even further down to the $15 to $20 barrel. Because there's too much capacity, not enough demand. And I'll get into that when we look at the global forecasts. So I want to highlight that. But if you look at this chart here, you see motor vehicles, it's done well. Forestry, machinery, done well. Food processing, done well. Consumer goods have done well. Now, 44% of exports are finished goods. So there's always a misnomer when you hear unions talk that Canada doesn't manufacture. We still manufacture here. But manufacturing's changed a lot since the 80s, just by the way everything is done here. More automation's been brought in and different ways of doing what we call advanced manufacturing. This one gives you a good example of commodities. So if you go back and look at the chart and you see where oil prices is, We're at $42.44. We haven't seen this level of oil pricing since about the 2005 range. We haven't seen it. So this kind of shows you where we have, but it's not just oil. If you look at natural gas, and you look at 2008, we were up to about $8.86 per cubic foot. And now we're at $2.09. Look at nickel. It's half of it. Look at copper. It's down. So it's all the commodity prices, with the exception of, if you look at lumber, have done poorly this year. So if you look at your stock markets and your mutual fund, it's not surprising that when you look at the returns on your mutual funds this year, they're probably in negative growth, because they're driven a lot by oil stocks, they're driven a lot by mining stocks. Now, most mutual fund managers are trying to diversify a bit, but they still can't get away from that. So that's why you're seeing this year a lot of your mutual funds being hammered. Now let's talk about currency, because this is very important, because the Canadian dollar's built up based on the commodity prices, and we've seen it drop significantly. So this chart kind of shows you what's happening in terms of the forecast of the dollar. I believe the Canadian dollar will stay probably between the 68 to 74 cents for the better part of a couple more years, until the commodity prices start to return and recycle back. But you're going to see low dollars. And what does that mean? Well, if we bring in food from the US, imports, it's actually going to make it cost more in terms of the consumer spending side. But you should also see an aspect too, as well as lower fuel prices should start working themselves through the pumps as well. So that's all being said in terms of things. This doesn't impact poor government policies that are being talked about from the provincial government in Ontario, which is talking about the Ontario Registered Pension Plan, or having carbon taxes, which will also impact consumer spending. But I wanted to highlight you on the currency side. Let's talk about global forecasts. A lot was said by the Liberal Party and during the election. A lot's been said about people, but there's things you guys need to understand in general about global forecasts, especially with China. China's numbers are not as good as people think they are. They're inflated. China is not likely growing at 6%. China is likely growing at 3%. That's significant, okay? Because China, with its population of 1.2, 1.1 trillion people, is key for exports and imports. So if its economy is struggling, it's only going to make sense where Canada has one of its major trading partners as that. So it's very important to understand, basically, that rationale to know what's going on, because realistically, people are looking at China as being a savior. Its economy is not going to be very good for a while. So you got to, as Canada has to do, is has to look at diversifying itself. And part of diversifying itself means it has to look at other markets like India, Colombia, to kind of buffer that loss of growth here. The other thing is we'll never see economic growth, the 4 to 5% range, for the longest time, because we have a demographic shift that comes into play where the baby boomers are aging a little bit more. So that kind of wraps up what I wanted to kind of talk about in terms of the overall economic growth. Thank you.